All right. There we go. Now we're live. Good morning, everyone. Happy Friday. We pulled the chat up so you can drop a comment in the chat if you're tuning in. And we will wait just a few minutes here. Make sure we get to go live on all the platforms. Give everybody a chance to tune in. All right. Happy Friday. People checking in the chat. And like I said, we're just going to wait a few minutes here to get started, give everybody a chance to jump on, make sure we're live on all the platforms, all that good stuff. All right. All right. Looks like we are live on all the different platforms, so we can go ahead and get started. So let's go ahead and take off the chat, and we will get into it. All right, welcome everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, joined by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. However, we also do conventional FHA, VA, and today's topic, which is USDA loans. So every morning we go through the live rates of different programs so we can see how the market is reacting. Very interesting to see the rates go up and down and how they work. So we will go through that here today. But after that, Jose is going to take us into a deep dive on USDA loans. So we'll go over a little bit more about USDA loans. Some of you may know about it. Jose might talk about some of the things people don't typically know about USDA loans. So we'll get into that deep dive in a couple of minutes. But first, let's do what we do every morning, which is have Nick pull up our pricing tool, and we will go through the actual live rates for today.
All right, let me pull up my screen here. And we can get started. So this is our pricing tool for our team of mortgage professionals. If you'd like a full loan estimate, please get with our team. We have over 300 licensed loan officers in every state and are licensed in 22 states for primary homes and can do business purpose loans in pretty much all states. So what we will do today is check out the rates today with our tool. It is March 17th, just after 11 a.m. Eastern. So all of our programs are live. So we're going to set up a basic scenario for every quote we do. We're going to do a nice easy loan amount of $400,000, an LTV of 80%. That means 20% down payment. And a desired price of $99. That means we're going to look for the best rate at one discount point in cost. And we're going to go through our conforming conventional programs first. Then we will do our FHA programs. And then we'll go through our non-QM expanded guidelines, where we have over 4,500 additional loan programs besides the 4 you see here. We will not do VA. That's only for our eligible veterans. So if you are eligible, please get with our team. We can quote that in less than 5 minutes. And Jose will go into a deep dive of USDA and explain that only certain properties are eligible. So we do not do that live either. Let's go ahead and do our conforming conventional rates for a purchase, 30-year fixed, standard scenario, primary, single family, 1 unit, state of Florida, county Miami-Dade. That's where our office is. Estimated FICO for all of our demos will be 760. Estimated debt to income for all of our demos will be 40. And let's see what the rates are this morning. So looks like right about the same as yesterday. We got a 6.5 rate for one discount point in cost and a final APR of 6.676. So some good options here for conventional. We love it when it goes down. Last week we were in the sevens. Now we're in the sixes. That's excellent. Now let's go back to our pricer and compare our FHA programs to that. Typically, if a customer doesn't qualify for conforming, FHA is usually the next option. So we'll keep everything else the same. And FHA does allow a little bit of expanded DTI and other guidelines. And we'll see here the rates are usually lower as well, 5.625 for one discount point in cost. But the APR is very similar. Remember, FHA has mortgage insurance that's always required. And so it has a upfront and a yearly that is paid monthly. So make sure to compare the APR so you compare apples to apples. And just as the last few weeks we've seen, FHA is actually a little bit lower in APR with the recent changes. So great options there. If you're looking for FHA, it actually is a little bit lower in APR, so you can compare them side by side. Now, for our final live pricing demo here, we will go through our expanded guidelines. Many times, other lenders or banks do not have any other options besides conforming or FHA. Fortunately, here at the Mortgage Calculator, we specialize in non-QM. So we select expanded guidelines here, and we have over 4,500 loan programs, specifically with alternative income documentation that we can use here. So we'll set everything else the same, but we see one new option pops up, and that's our income verification, where we can use alternative income. So full doc is 2 years tax return, just like any FHA or conventional loan. However, we will typically use the non-QM programs to use alternative income. So we have 1 year alt doc, 2 year alt doc, asset related programs, business bank statement programs, investor DSCR programs, and our most popular program by far for a primary home purchase is going to be our personal bank statement 12-month program. So that's what we're going to do our demo today. And that's going to be for our self-employed borrowers. Many times our self-employed borrowers, when they submit 2 years tax returns, they have various write-offs that for various reasons may not allow them to qualify at all, or may not allow them to qualify for as much of a home. So we will use 12 months of bank statements here to determine a debt to income ratio based on the bank statement income, not the tax return income. So here we'll typically get more income and therefore qualify our borrowers for a larger home. So let's check out our non-QM rates this morning. So looks like the best option the computer found is a 7.375 rate for one discount point in cost. And the APR there is 7.422. So you notice when we're comparing APR apples to apples, it's obviously a little bit higher here, but not much. It's just about 1 point higher. And remember, these are for customers who would otherwise not qualify at all or otherwise not be able to get the home that they're looking for. So these programs are very amazing options for us to present for our borrowers to give alternative options. Also, keep in mind the borrowers will typically qualify for more income using these alternative documentation. There are dozens of these programs available, so please get with our team to find which one may fit you. Some of these may allow things like a credit event, like a foreclosure, things like that. So just tons of different options that we have available. Obviously, the ones that may allow foreclosure might be at a little bit higher rates there. Now, before we go into Jose's live examples, we always want to do our final pricing scenarios for investment properties. So we love to work with our investors, whether they're first-time investors or seasoned investors with dozens of properties. We have options for those. So let's do our final scenario. Same thing, 80% LTV, 20% down payment, a desired price of 99. That means one discount point. We're going to find the best rate at one discount point cost. And we're going to compare our conventional conforming to our expanded guidelines non-QM. And FHA, VA, USDA, they're not eligible for investment properties, so it keeps it nice and simple. We'll just compare two options. So first we'll select our conforming. We'll keep everything else the same. And let's check out our investment property conforming conventional. So just as we do every morning, I always warn everybody that the GSEs that insure these programs, right, they have added penalties for investment properties to discourage investors from using these programs. So great rates here, 6.625, but you see high discount points. So there's been additional discount points added to these, not by us, of course. These are just the program parameters. So 3.875 discount points there for a final APR of 6.897. So still great options for low rates, just higher costs. Many of our investors don't mind raising the rate a little in order to lower the discount points so they can invest in other rental properties. So if we cruise down here, we see some higher rate options with lower discount points. Looks like this would be a good option, 7.5 rate for 2.75 discount points. But again, not a lot of flexibility here under the conventional programs. And that's where our non-QM programs come in. So we'll do our final scenario for the live rates. We'll pull up the 80 LTV. We'll switch it to investment. And this time, we're going to compare our conforming options to our non-QM expanded guidelines in order to find some alternatives, hopefully for less discount points. So when we go to income verification, the most popular program by far for investment properties is going to be our DSCR, debt service coverage ratio. Again, that's because there is no income required, no borrower employment required, and no borrower income required. We're simply going to use the estimated rental income from the property to determine that the rental income from the property we're purchasing can cover the PITIA, the mortgage payment of the property. So pretty simple calculation there. We have tons of programs for properties that can cash flow greater than one, right? They can cover the expenses, but we even have options for properties that may not even quite cash flow at the one ratio, for under one and even no ratio. So lots of different options here under the DSCR. And most importantly, we don't need anything from the borrower. Now there's always a prepayment typically added to our non-QM investment properties. So we can choose zero prepayment. That's going to cost more and give us less programs. So we always choose 3-year for our demo. Today, we can go up to 5 years to save a little bit more money. But for the most common scenario, most loan program options, we're going to choose 3 years here. And let's check out our DSCR rates this morning. So yesterday they were down into the high sevens. Today they've gone up a little bit here. So best option the computer found this morning, 8.25. So low 8, still better than last week here. And discount points of 0.975. So again, many times our investors want options to go up higher in rate as long as the property cash flows in order to reduce the cost. So here's a great option for that. Obviously a higher rate here, 8.25, but less discount points that we can have here. And always compare the APR, so you compare everything apples to apples. There's a ton of programs, as you saw when I went down the list, tons of different DSCR options for different DSCR values. Some of these programs may allow things like short-term rental income and other variations with these programs. So please get with our team so we can find the best program to fit with your exact scenario. Now, let me switch my screens up and introduce our deep dive topic for today. 1 second, let me take the pricer down. And before I pass it over to Jose, we just want to go over our topic for today. It's going to be USDA loans. These are loans, as I mentioned every morning. We can't always quote everybody on these because they are only in rural eligible areas, right? So we always have to go to the USDA map, see if you are searching in an eligible area, see if the actual property you're looking at is in the actual eligible area, and then we can quote it. So again, that's why we don't do the rates live, because we have to make sure the property complies first before we can offer a valid rate quote. But in this scenario, Jose is going to go into a deep dive, obviously with an eligible property in mind, and go ahead and give us some example scenarios for USDA. So you ready to take it over there, Jose?
Yes, sir. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Jose Gonzalez, Sales Manager. USDA Loans, amazing product. Some of you may have never seen one in your life, and others, that may be all that you do. It's really location-based, right? One of the things to consider when I mention it's location based is that a property, in order or a loan or a borrower, let's say, in order to be able to qualify for a USDA loan, has to make sure that the property is in an area that is approved for USDA. There is a specific USDA geocoder that you can search and plug in the address for any property to ensure that it qualifies for USDA. So this will require the buyer, the realtor, and the lender to work closely together to ensure that they're not needlessly considering properties that are not applicable for USDA. So in our process here, when we pre-approve the borrower, we have to be clear to communicate that the pre-approval will always be subject to the property qualifying for USDA based on the location. So yes, we pre-approve our borrower, but then keep that in mind. So USDA loans are basically directed towards our agricultural and farming communities. That is the objective of the program. However, you don't have to work in the farming or agricultural industries to qualify for a USDA loan. It's open to every borrower, but it is specific to those areas that are going to have higher concentrations of that type of population, which is going to result in it being a more rural, RURAL, rural-based lending product. That is a great solution for our borrowers that may look at a property and that would not qualify under normal conforming or FHA loan guidelines due to rural nature of the property possibly being coded by the appraiser as being rural, the comparable sales for the appraisal being too spread apart, that may render that appraisal not usable for a conventional or an FHA loan, but perfectly acceptable for a USDA loan. I mean, a lot of times those of us that may not have a lot of experience dealing with USDA loans may totally overlook this possibility when looking at properties, when pre-approving borrowers. So, a lot of times we face that obstacle with, there's a dirt road in front of a property, there's a gravel road in front of the property, it's going to be, the appraiser put it as rural, what am I going to do? And they totally forget that if it's a primary residence, because USDA is for primary residences only, not investment properties, if it's a primary residence, then USDA is definitely an option as long as the property falls within the limits of USDA or within the boundaries of USDA. So let me share some examples here with you of some USDA quotes, right? My first example that I have here is just for a standard USDA purchase, 100% loan to value, $500,000 purchase price, and obviously $500,000 loan. So you will note here, very aggressive rates. 6.625 actually has a lender credit of $1,225. So that could be an extra little bump to for your borrower. And the lowest rate option possible is 5.5% at a cost of just a little bit over 2%. So now we go to our USDA 100% LTV rate and term refi. One note I will state here is that USDA does not allow cash out refis, right? This is supposed to be a sort of an assistance-based type program. They're helping out with reduced mortgage insurance and 100% financing, usually reduced credit requirements. So they don't really want to position this program as a cash out option, right? This is There is obviously some subsidies going on in here, and that's not for the purpose of profiteering on a cash out refi. So in our scenario here, you'll see great rates as well, right? 6.25% has a lender credit of $1,840. That's pretty good there. 6.125 is at par, and 5.125 is the lowest available rate option at a cost just a little bit over 2 points. So now I'll show you another FHA refinance option, the streamlined refinance option. Most of you may not even be aware that a streamlined refinance option exists for FHA. The main benefit of this option, because it's the same MI, this, all the other same requirements, but the main benefit here is that it does not require an appraisal, similar to the FHA refinance in that respect, but that is really where the similarities end, because in the USDA streamline option, it does review income. So obviously DTI is still a consideration. The borrower needs to have been on time on their payments for at least the previous 6 months. It has to be a USDA to USDA transaction, right? So you can't do a streamline if you're coming from any other loan other than a USDA, right? So I mentioned income still reviewed, USDA to USDA, 6 months on-time payment, no appraisal requirement. And now here's an exciting option that many of you may not know exists either, is the one-time close option for USDA loans. 100% financing of your purchase, amazing. This is a good option because, the one-time close option allows you to purchase the land that you're going to construct the home on, build the home, and then have your end loan all in one product, all in one process. When you close that loan, you're closing your construction loan, your land purchase loan, and your end loan at that time. And then you start the construction process. And once the build is complete, however much time they allotted in your loan, then that loan then rolls over to being the end loan. No 3 separate closings, no need to refinance out of a hard money loan that you use to purchase a land, no need to refinance out of a bridge loan that you may have used to construct the home, and no need then to reapply for an end loan and pay additional closing costs, right? Everything is done in one shot. USDA, 100%, amazing deal. So again, it's pretty tough to find a home for your high LTV borrowers in some markets that are really tight with inventory. So this could be the perfect solution to resolve that tight inventory scenario. Buy the land, build your own home the way you like it. So 4 amazing USDA options for everybody out there to consider. So really looking forward to helping you structure your 100% LTV finance loans. Please remember, great solution for rural-based properties.
All right. Thank you, sir. So great info there. Again, a lot of info there that I didn't even know too as well, some of that stuff, right? So it's not just that basic as some of us may think. So great examples there. We have 350 loan officers all around the country, licensed in 22 states, as Nick said earlier, where we can do these USDA loans. So we would be more than happy to pair you up with one of our loan officers that can consult you through the process of all these different options. So go ahead and visit us at themortgagecalculator.com, or send us an email to info@themortgagecalculator.com, and we can pair you up with one of our loan officer consultants. Now, not only can our loan officers do conventional FHA, VA, and USDA like we talked about today, but they are also trained in the expanded guidelines non-QM products like Nick went over, where they can consult you through the process of everything from bank statement loans to DSCR investor loans, all the way to the fix and flip and commercial and ground up construction. We have everything under the sun. So go ahead and visit us, themortgagecalculator.com, and we can pair you with one of our loan officer consultants. We do this show every single weekday at 11 a.m. Eastern time. So you can tune in every day and see how the rates fluctuate. And then we do a deep dive into a different subject, just like we did today with USDA loans. So thank you, Jose. Thank you, Nick. Thank you, everyone, for tuning in. And we hope to see you on Monday at 11 a.m. Eastern. Have a great weekend, everyone.
Thanks, everybody.
Thank you, everyone.